December 2001, America's seventh largest company goes bankrupt. Most people still believe wealth comes from something solid. A product, a factory, a service, trucks moving. Inventory leaving, customers paying, reality. Something you can point at without needing a consultant. 3 acronyms, and a whiteboard covered in arrows. Enron trained everyone to stop demanding that. At first, it was boring. In 1985, this thing was basically a Houston pipeline company born from a merger. Pipes, gas, bills, infrastructure, the kind of business that makes your eyes glaze over. Before the second spreadsheet opens, nobody outside a tax lawyer's office cared. Then the costume change began. Ken Lay steps in. Economics PhD, executive smile, perfect tan. The polished confidence of a man who could sell turbulence as progress. His big idea was deregulation. If government stopped setting energy prices, energy wouldn't just be delivered, it could be traded, packaged, gambled on. Suddenly the money wasn't in moving gas through a pipe. The money was in turning that pipe into a story about limitless upside. And Wall Street loves a story far more than it loves a meter reading. Then came Jeff Skilling, a McKinsey consultant with a kind of confidence that can make nonsense sound like innovation. If you say it fast enough near a projector screen, his pitch was genius in the most dangerous way possible. Stop thinking of Enron as a pipeline company. No, that is too small, too physical, too checkable. Enron was a technology company, a market maker, a vision machine. It didn't sell energy. It sold the future of energy. Listen to how seductive that is. The moment a company stops describing what it does and starts describing what era it represents, investors lose their survival instincts. Nobody wants to miss the future. That phrase has emptied more pockets than any pickpocket in history. If you asked what Enron actually did, you often didn't get an answer. You got theater, a shrug, a whiteboard, 40 minutes of jargon, boxes connected by arrows, energy flows, risk transformation, dynamic markets, synergy, platform, innovation, translation. Please stop asking where the money really comes from. Meanwhile, the stock kept climbing, and rising prices have a terrifying effect on human beings. They erase curiosity. That is how wealth destruction begins in respectable clothes. Inside Enron, the culture matched the illusion. Employees were told they were the smartest guys in the room, which is corporate code for arrogance is a KPI now. Perform or disappear. Big bonuses, quarter-end panic, constant pressure to impress investors. Deals, margins, growth, numbers, applause, everybody running faster. Because in a machine built on expectation, slowing down is fatal. And here is the part that should make you angry. To the outside world, this looked like excellence. Fast growth, elite talent, digital platforms, media praise. Executive confidence, expensive offices, all the symbols people mistake for value. But symbols are not value. A rising stock is not proof. A complicated explanation is not a moat. And being called innovative for 6 years straight does not mean you built anything real. Sometimes it means the fog machine is working. So before we even get to the accounting tricks, the hidden liabilities, the financial acrobatics, and the flaming chainsaws disguised as strategy, you need to throw away one deeply cherished myth. Markets do not always reward substance first and punish nonsense later. Very often, they reward the best performance, the cleanest narrative, the boldest promise, the company most skilled at making emptiness look expensive. And Enron understood that better than almost anyone. What is the first company you remember? That made you feel smart for not understanding it. Here is the part that should make your stomach drop. Enron's stock goes from $7 in 1997 to more than $90 by 2000. That is not pretty good. That is over 1,000% in 3 years. The market sees that line on the chart and decides the company must be brilliant. Because numbers going up have this magical effect on the human brain. They turn confusion into trust. Now freeze that image for a second. A worker sees the stock climbing. A fund manager sees the stock climbing. A TV anchor sees the stock climbing. Nobody is reading the plumbing under the building. They're staring at the neon sign on the roof. And the core trick is almost insultingly simple. Enron signs a 10-year energy contract. In a normal universe, you earn money as the cash actually comes in. 1 year, then another year, then another year. And look at the math of the illusion. Asset loses value. That is why the stock could go from $7 to over 90, while the foundation was cracking underneath. The share price was not proof the business was healthy. Media called it a miracle. Executives called it a party. Of course they did. If the market rewards appearance faster than truth, The best dressed lie wins for a while. And the names alone tell you the vibe. LJM1, LJM2, Raptor. These are not the names of sober machines built to protect ordinary people. They sound like rejected villains from a late-night cable movie. But as long as the chart kept climbing, no one wanted to be the person in the room saying, "Sorry, can someone explain where the cash actually is?" Because that is the fatal split in finance. Reported profit is one thing, actual cash is another. And once a company teaches the world to confuse the two, it can look rich while bleeding underneath. So before we even get to the people cheering from the top floor, sit with the arithmetic here. A stock up more than 1,000%. Profits counted before they arrive. That is not genius. That is a time bomb wearing a silk tie. What is the first financial buzzword that made you stop asking questions instead of asking better ones? Here is the real hierarchy inside a scam like this. The people at the top don't just get paid more, they get paid differently. Salary is for the workforce. Stock options are for the priesthood. Bonuses, villas, private jets. That is not compensation for creating value. That is the extraction layer. That is what it looks like when a company turns belief into a cash machine and routes the cash upward before gravity notices. And down below, regular Enron employees are being told to stuff their retirement plans with Enron stock. Their 401k isn't a safety net anymore. It is a hostage situation with quarterly statements. Imagine the scene: fluorescent office light, stale coffee, HR smiling through a benefits presentation. And somewhere, in the fine print, your future gets welded to the same company, signing your paycheck. If the stock goes up, great, everyone cheers. If it implodes, you don't just lose a job. You lose the nest egg, the house plan, the college fund, the illusion that loyalty was ever part of the contract. That is the split almost nobody says out loud. Risk for workers, liquidity for insiders. The executive class gets options. They can cash out. The rank and file get confidence. One side gets diversification. The other gets a motivational poster and a login screen. So when people say we're all in this together, translate it properly. We are all inside the building, but only some people know where the exits are. And Wall Street, supposedly the adults in the room, the referees, the sober voices, please. Major analysts keep slapping glowing buy ratings on Enron. While their firms are doing business with Enron, Merrill Lynch makes millions managing stock offerings, and then turns around and praises the company's financial health, like a waiter reviewing his own menu. Objectivity becomes a decorative item, and revenue is whatever the story needs it to be. This is how the harvesting works. Not with one dramatic theft, but with a whole class system. A system built entirely on information and timing. The public gets the dream at full price, and the insiders get the term sheet. Analysts get fees, banks get deals, executives get exits, and employees get trapped. Shareholders get seduced by complexity. They mistake for genius. And confusion becomes a feature, not a bug. Layers of jargon, spreadsheets dense enough to make your eyes glaze over. A business model explained like a magic trick. If you're still asking where the money comes from, clearly you're not sophisticated enough. That is the ugliest part. Complexity isn't there to clarify value. It is there to protect the people extracting it. If the numbers were simple, too many people would notice. The emperor isn't wearing a balance sheet. So the company keeps the fog machine running. Keep talking fast. Keep saying innovation. Keep making boring fraud sound like frontier science. By 2000, Enron's image is practically armored. Bulletproof, reputation, magazine covers, applause. The kind of public adoration that makes doubters feel stupid for doubting. Until one brutally impolite question cuts through all of it. Where is the actual money? And watch what happens next. Not to the workers, not to the pension money. Watch what happens to the people at the top. August 2001, Jeff Skilling, CEO of the hottest company in America, drops a resignation letter on the desk and walks. No grand explanation, no alarms. Just a weirdly casual exit from a company supposedly on fire with success. That alone should tell you everything about class position. In financial collapse, the lower you are in the structure, the longer you're told to stay calm. The higher you are, the earlier you can leave. So before the scandal even fully detonates, the map is already visible. There are owners of the story, and there are victims of it. There are people using stock as a tool, and people being fed to stock as fuel. When you see that split once, you start seeing it everywhere. Who gets paid first? Who gets locked in? Who gets the upside? Who inherits the ash? What do you think? is the clearest red flag. Insiders cashing out, employees being told to buy more, or analysts cheering while collecting fees. If you want one practical defense against a company like this, it is not be smarter. That is too vague. Vague is how people get robbed in dress shoes. The move is smaller and uglier than that. The next time a company sounds brilliant, but you cannot explain it in one dead simple sentence, how it gets cash from a customer, you do not buy it that day. Not after the interview, not after the earnings call, not after your favorite genius on television says this changes everything. You wait 24 hours and write one line on paper. Who pays them, for what, and where that cash shows up. If you can't fill in that line without using words like platform, optimization, ecosystem, transformation, or revolutionary, that is your answer. Not do more research. Your answer? Because this is where the trap closes. Fraud rarely arrives looking dirty. It arrives moisturized. It arrives with slides, acronyms, a laser pointer, and a face that says you're the idiot for asking basic questions. Enron's books looked like a raccoon had done tax planning at 3 in the morning. And the response was not clarity. It was jargon. A wall of polished nonsense. Energy arbitrage, mark-to-market, structured swaps. Maybe some of it was real. That is not the point. The point is that complexity became a weapon, and regular investors, employees, even professionals started nodding along. Because nobody wants to be the only person in the room saying, sorry, what exactly do they sell? That one sentence could have saved people 20 years of retirement. So make the habit mechanical, open the annual report or the investor deck. Ignore the story for 60 seconds. Go straight to revenue, cash flow, and dilution. Then ask 3 boring questions out loud. Did revenue become cash? Did insiders sell while telling everyone else to hold? Did the business need a translation team just to sound legitimate? If 2 of those answers make you squint, you step back. No heroics. No hot takes. No, maybe the market doesn't get it yet. Step back. That pause is not cowardice. It is insulation. It is how you keep a PowerPoint from reaching into your paycheck. And yes, this sounds almost insultingly simple. Good. Useful financial habits usually are not sexy, not cinematic. No alpha male violin music in the background. Just you, a statement, a pen, and 10 minutes of refusing to be hustled. Enron fell from nearly $90 a share to under $1 in a few months. Because reality eventually does what reality always does. It sends the bill. By the time the headlines say accounting errors, the exits are already crowded. And the people at the top are halfway to the parking lot, with your money in the trunk. So I'm curious, what is the fastest red flag for you? Jargon, insider selling, or profits that somehow never become cash? And this is the part people always get wrong. The lesson is not that regulators will save you next time. They arrive with badges, subpoenas, and very serious faces. After the money is already smoke. The lesson is not that prison fixes the damage. Name it.